recently who said when he teaches Principles 2, he kind of glosses over this chapter. Not a good idea, because that means you got a whole lot more work to do when you get to this course, because you should have already been exposed to this initially. Accounting for investments. All right, now, here we're talking about marketable securities. What do we mean by the term marketable securities? They're traded. That means you can find out what they're selling for. That's not a private company, it's a publicly traded company, whose stock we can look up and tell exactly what it should be selling for, and whose bonds we can tell what they should be selling for. So they are traded, is the key term. All right, so that's important. Then, when we talk about securities, what are we talking about? We're talking about stocks and bonds. That would include both preferred stock and common stock. Preferred stock and common stock. But here's the key. Somebody explain to me the relationship between accounts receivable and accounts payable.
Receivables department is the one that's intaking the checks, all the revenue, anything like that. Somebody might owe you. Payable's the one paying the bills, keeping the lights on.
Okay. Is there a connection between the two?
Well, if you don't receive the money, you can't very well pay anything. Yes, that would be their own connection. I mean, they are.
Well, I mean, they're in the same building and all that kind of stuff, yeah.
Yeah.
But I'm looking deeper.
You
I'm
can
trying
have-
to get you to think deeper.
You can have receivable income off of debt investments you have in accounts payable.
Okay, let me give you an example and see if it crystallizes it for you. We are hiring a new faculty member who will start in August in the Department of Accounting. And let's just make believe that the office where he will be located is empty. And so a few weeks before he gets here, we will call an office equipment company to say, would you please bring a desk, an executive chair, a guest chair, a credenza, and 2 bookcases to put in this office. And whoever that company is that we call to ask that will come out and deliver equipment, and then they will go back to their office once they deliver the equipment, and they will record a receivable, right? So they debit accounts receivable dash University of South Alabama, and they credit what? Sales revenue, right? Okay, what does the University of South Alabama do? Debit?
What do you provide, equipment?
Property, plant, and equipment. And what are we gonna credit? Accounts payable dash office equipment company, or whoever it is. So listen carefully. Accounts receivable and accounts payable are different sides of the same coin. Okay? So I need you right now to make a switch in your brain. In chapter 15, we were issuing preferred stock, common stock, buying treasury stock, and reissuing treasury stock. you were the corporation that was issuing the stock. In this chapter, you're not issuing the stock. You are buying stock in another company as an investment. In chapter 14, we were the bond issuer. We issued bonds. In this chapter, you're buying somebody else's bonds as an investment. So before it was a liability. What are investments in stocks and bonds going to be for you in this chapter? Assets. That's the key. Assets. Now, I do this a little differently than the book does. We're going to call this stock, investments, and debt investments. And those are both asset accounts. Debt investments and stock investments. Your book refers to them as equity investments, but that makes me nervous because that's going to make you think these are stockholders' equity accounts, and that's not what we want. So I'm changing the account title to stock investments. Okay? So we got a bunch of new stuff now in this chapter. On the balance sheet, we're going to have some new account titles. Under assets, we have stock investments and debt investments. Now, where these will appear on the balance sheet depends. And we're not going to even address that for a few minutes. Then we'll address it. What are our options on the balance sheet under assets? What are our options? Current. What's next? Long-term investments. Property, plant, and equipment.
And then prepaid, prepaid's 5.
Okay, tell you what I'm gonna do then. I'm gonna force you to learn. On your next exam, you will have at least 10 to 15 points that will come from Prescott's Got a Nose. So, don't learn it, and that'll cost you at least 2 letter grades going forward in the next 2 exams. There are 5 categories for assets. Current assets, long-term investments, property, plant, and equipment, intangible assets, and other assets. Don't call it long-term assets, because that's not right. It's long-term investments. Because think about it. If you have current assets, long-term investments, PP&E, intangible assets, and other assets. All of these are long-term assets, right? If they're not current, they're the opposite, which is long-term. So when you say long-term, that still doesn't tell me what category it falls under. So long-term investments is the category. And we'll talk about how we decide where they will be put, and we've got to figure out at what amount. right? We gotta have a dollar amount. And so we gotta figure out what that should be. What are our options?
You could sell it or you could hold on to it.
Okay, no. The question is, what are the options for amounts?
Oh.
What are some of the choices we gotta decide between?
Book value,
Book value, she said.
fair value.
Fair value. Cost. And the same thing's true for the other one. Cost / book value and fair value. So we gotta decide at what amount we're going to report them on the balance sheet and where we're going to report them on the balance sheet. Now, related to these investments, if we have them, we're gonna have some new income statement accounts too. If we buy stock investments, what is the related income statement account that could be related to an investment in stocks? Dividend revenue, right? You get paid dividends. Possible. Okay? What about bond investments? If you buy somebody else's bond, what do you get? Interest revenue. Where would those two items be reported on your income statement? In what category?
Under revenue.
Other revenues and gains and other expenses and losses. Other revenues and gains and other expenses and losses. Okay? Then we might also have gain or loss on sale of investments. Gain or loss on sale of investments. So you buy the stock for $10,000, it goes up in value to $12,000 and you sell it, that would be gain on sale. If you need a debit to make your journal entry balance, what are you gonna call it? Loss on sale. Loss on sale or gain on sale. Okay, now I want you to put the word realized in parentheses at the end. You don't use the term called realize, but this means it has happened. It's legit. You're better off or worse off because of it. It's a realized gain or loss. Questions? So, lots of new accounts. 1, 2, 3, 4, 5, and we're just getting started. So a lot of stuff to learn, where it goes, what its normal balance is. What's the normal balance of stock investments and debt investments? Debit. These are debit accounts. They're asset accounts. Okay? So now we're going to take debt investments and stock investments. Okay, for debt investments, we put all of these investments into one of 3 piles or categories. First is what's called trading securities. The second one is available for sale securities. And the last one is held to maturity securities. Trading securities, available for sale securities, and held to maturity securities. Okay? Now, you don't have to know this. They're going to tell us in the book whether the company is treating them as one or the other, which one they're telling. They're going to tell us that. We're not going to have to make up our mind. But trading securities, just listen, that's where you would put investments that you say, look, if we get a chance to sell this in a couple of hours, or a couple of days, or a couple of weeks, and make a profit, we're going to sell it. Trading means, may not be there a long time. Available for sale says, hey, we may keep it, we may sell it. We're kind of indifferent. What is held to maturity? Held to maturity says you're going to hold this bond until it matures. You do not plan at any point to sell these investments. So based on management's intent, that's the first thing. Where we put these is based on management intent. Okay? Before we go any further, do you remember from Principles 1 the historical cost principle? What do you remember about it, Miss Toomey?
I just remember the word.
You've heard it before.
No, you always keep it at like a certain, like you always keep it at book value or something. You never change it to like present value. I can't really remember it. Who knows? I know the word.
You know just enough to be dangerous. That's right. The historical cost principle says we record an asset at cost and generally leave it there. We do not adjust it. That's not what you said.
That's not the second part.
No,
I said you
well,
don't change it.
Don't change it. That's, yeah.
I told you I knew something.
A broke clock is right twice a day. It don't mean it's working. All right? So, why do we do that? Did you talk about that in 211? Why do we record assets at cost and then generally leave them there? The first part should be easy. Why do we record them at cost?
And that's what you paid for it?
No, I mean, that's what we paid. Doesn't that make sense? That's a reasonable thing to record them at, what you paid for.
And we keep them there because we don't want to say, oh, this is worth more than, because the price went up.
What if it's worth less?
If the price fluctuates, you would constantly have to keep changing the account.
Okay, well, here's my question. So he says the change in fair value may mean that it fluctuates in value. But my question would be, if the land has changed in value but we don't plan to sell it, what difference does it make to us? Doesn't matter. Or if it goes up, we don't plan to sell it, we got a building located on it, our manufacturing plant is located on it, our factory is there. So we don't plan to sell it, so it doesn't matter that it's going up. Plus, how would we figure out what the real value is?
It's appraisals again, right?
Do what?
Appraisals,
Appraisal.
yeah.
That's a guaranteed value?
No opinion.
No. let's hire 5 appraisers and don't let them work together. How many different numbers are they gonna come back with? So which one's the answer? We don't know. I told you about my buddy who is in banking. I went to see him one day and he was really depressed at work. He had just gotten back an appraisal. It seems that 2 years earlier, he had lent a person $600,000 to buy a home and piece of property on Dog River that was sold to him for $800,000. He said, I got $200,000 cash to put into it. I need a $600,000 loan. That's a 75% loan to value. And that's perfectly within bank policy. And so my buddy made him the loan. Well, shortly thereafter, we had the recession, the Great Recession hit. And the guy decided that he owed more money on this piece of property than it was worth. And so he quit making payments. Came in to the bank and brought him the keys and said, it's yours. So now it's the bank owned property. First thing you have to do is get an appraisal. The appraisal came back at $400,000. So now which one was right? Was $800,000 right the first time? Well, if it was right, it sure did change in a hurry. So, an appraisal is somebody's opinion of value. Now, it's supposed to be an informed opinion. It's supposed to be based on logic and everything else. It's supposed to be based on real sales of similar property in close proximity to that property. But it's still just a guess. But in this case, do we know what the stocks and the bonds could be sold for today? Why? Because they're publicly traded, therefore we have reliable, dependable, verifiable financial information. I can look up and tell you exactly what you could have sold that stock for at the close of business on March the 31st. So now I'm not making it up. Now I'm not hoping and guessing and winging a prayer. Now I know. So here's one place where we deviate from the historical cost principle and we go to fair value. Because in this case, we think fair value is both more reliable than cost and it's more relevant than cost. So, if you'll look on page 1 of your class notes from this chapter, I put them in reverse order. We'll start with, well, not reverse, but go to number 2, which is trading securities. This is what's important. After the first semicolon, it says, these investments are reported on the balance sheet at fair value, with unrealized holding gains and losses reported as part of net income on the income statement. Realized gains and losses are always recognized on the income statement upon sale. So the realized gains and losses do show up on the income statement in every case. But in this case, what is an unrealized gain or loss on trading securities debt investments categorized as trading securities? What would an unrealized gain or loss be?
Is that like when,
Mr. Jackson?
whenever the value changes, is that?
And you still hold it, you didn't sell it. So you bought a bond for $100,000, and now the value of the bond has increased to $105,000. That is called an unrealized holding gain. That make sense? So we could also put in here unrealized holding gains and losses. Now, in this case, we do have to use the word unrealized to make the readers know we didn't get cash for this. This is a paper profit. It's gone up in value, but we don't have any dollars to back it up. Are you with me? So, trading securities are shown on the balance sheet at fair value with unrealized gains and losses reported as part of net income. Okay, now watch this. So, if we started out, we used $100,000 of cash and bought a $100,000 market value bond. Okay? Several weeks later, once it's time to prepare our balance sheet, the value of the bond is now $105,000. So, you're going to have to increase assets by $5,000. But I got to keep the accounting equation in balance. Right? How am I going to do that? Stockholders' equity, she says. Okay? How is that, Ms. Pruitt? What's the account called? Be careful. Don't look. Don't look down there.
For stockholders' equity, would it be the comprehensive income?
Comprehensive income? What did I say about trading securities? The unrealized holding gain or loss is reported in, what does it say? Look on your notes. Huh?
On the balance sheet?
No. Trading securities, you're not looking at the right one. Unrealized holding gains and losses are reported as part of net income. Net income gets closed into retained earnings. Retained earnings is part of stockholders' equity. So that's how we keep the accounting equation in balance. It goes through the income statement, becomes part of retained earnings. Retained earnings is part of stockholders' equity, so that's how we do it. Okay? Now go to number 3, available for sale securities. These are ones we might hold, we might sell, we just don't know. These are reported on the balance sheet at fair value, with unrealized holding gains and losses reported as other comprehensive income and as a separate component of stockholders' equity. Realized gains and losses are still reported on the income statement when they happen. Okay. You told me the other day that in 371, you learned about the 4 main components of other comprehensive income. And the only reason you still remember it is why? That catchy little phrase, right? What is it? Maybe I'm wrong, you don't remember it.
Puffy, P-U-F-F.
Puffy, there you go. All right, so P-U-F-E, okay? What does the P stand for? Pension adjustments, you covered that in 371. What does the U stand for? Unrealized gains and losses on available for sale debt investments. Here's where we are, right here. Then the F and the E, we cover both of those in 416.
What's the E again, cause he really don't go over the E. He gives us puff. You added the E.
So the P you covered in 371. The unrealized holding gains and losses on available for sale securities is right here, this chapter. And then the F and the E we cover in advanced accounting in 416, should you be fortunate enough to make it to that point. All right? So now we've covered, both of these are reported on the balance sheet at fair value. Right? But how the unrealized gain or loss is handled is different depending on which category it falls in. If I were a note card person, these would very definitely be note card items that I need to create. Okay, held to maturity securities. These are ones we plan to hold until they mature.
Can I ask a question real quick?
Sure.
So you mentioned twice in there that available for sale debt securities, does that not include stock?
No. We're only talking debt investments right now. Only talking debt investments. Are you with me? Okay, listen to me. Mr. Finance. What causes the fair value of bonds to change?
The changing market rate.
Change in a market rate of interest. And the other one is change in creditworthiness. If you hold the bonds of Delta and it looks like Delta's about to go under, remember I gave you the example of Ideal Basic Cement we sold for 52 cents on the dollar? Well, that was because they didn't think Ideal Basic Cement was going to survive. And it didn't. It went out of business. So, but the main thing that affects it is changes in interest rates. What is the relationship between bond prices and interest rates? Inverse relationship. If interest rates go up, what happens to the value of the bond? It goes down, and vice versa. But look, if you intend to hold the bond until it matures, do these fluctuations in fair value matter to you? Because if you hold out until it matures, what are you going to be paid? What's it called?
Par value, face value.
The face value or par value of the bond. So the fact that it goes up in value or goes down in value means nothing to you because you plan to hold it. That's why you put it in this category, held to maturity. I plan to hold it forever. Okay? So, look at this. Look what we say for that. Number one, it says, these are investments that the company has both the intent and the ability to hold to maturity. The intent and the ability to hold to maturity. Okay? These investments are reported on the balance sheet at amortized cost. And write this, I need you to add on to this. With no recognition. With no recognition of unrealized gains and losses. with no recognition of unrealized gains and losses. Because they're irrelevant to you. Okay, one more thing I want you to write. Put a big old asterisk by number 1, and then come down here to the bottom and put another asterisk and write this. For investments in bonds, we do not use premium or discount accounts. If you are the issuer of bonds, no, don't write this down, that part. If you go back to chapter 14, when you issued bonds, if you issued them at a discount or at a premium, you had a separate account. Now, as an investment in bonds, you do not have a premium or a discount account. Instead, you record, listen to me, you record the bond at cost. So, if the interest rate, the market rate of interest has gone down since your bond was issued, then you're probably going to have to buy the bond at a discount, right? So you will have it at $950,000 instead of $1 million. That's the cost, but it's also amortized cost. And then look at me. Over time, you're going to increase that 950 up to $1 million at maturity. Those changes are called amortized cost. You're amortizing the inherent premium or discount. You just don't have a premium or discount account. You keep up with it all in one account called debt investments. Are you with me? Questions?
Is that because you're gonna be paid the face value upon maturity? Is that why you?
No, it's simply because we don't want to confuse readers with a premium or discount account. And we really don't need a separate account to be able to do it, because I'll show you when we do a problem on it. When you do the amortization chart,
Right.
where you have cash, this time instead of cash paid, it'll be cash received. And then instead of interest expense, it'll be interest revenue. And then the amortization of the premium or discount is the difference between those two. And so then you would change from 950, if you're going to $1 million, you would add to it the amortization of the discount that you bought it at to get to the new amortized cost. Okay? Yes, sir?
Why is that only for held to maturity?
Because those are the only ones. Well, I mean, you also, you have amortized costs for available for sale too. But you don't put them on the balance sheet at that. You put them on the balance sheet at fair value.
Oh, okay.
So remember, we had to adjust them from amortized costs to fair value on each year end. And same thing for trading securities too. Questions? Are you with me?
Yes.
So, I mean, that's a lot of information, and all we've done is cover this side. If I were doing note cards, you probably can't get all three of these on one. I don't know. If you write small letters, you can. For accounting for debt investments, trading securities, what I would put is a summary of what you see on page 1 of your class notes, shown on the balance sheet at fair value. with unrealized gains and losses reported as part of net income. Realized gains and losses always are part of net income. Then I would go to available for sale. Shown on the balance sheet at fair value with unrealized gains and losses reported as part of other comprehensive income in the stockholders' equity section of the balance sheet. Held to maturity reported on the balance sheet at amortized cost with no recognition of unrealized gains and losses. And I would somewhere put on that note that held to maturity securities, only those that the company has the intent to hold to maturity and the ability to hold to maturity. Because that, I mean, folks, that's a bunch of multiple choice questions right there.
How would they not have the ability to hold that?
If you think your company is in financial distress and interest rates are going up, what's happening to the value of their bonds? They're going down. So they may say, hey, we can't really afford to take a $300,000 hit to our equity, so we're gonna go ahead and sell these bonds. So you don't have the ability to hold until maturity. Questions? Okay, page 2 of the class notes. Now we're going to talk about investments in the stock of another company. And it depends on influence. Look at the chart that's at the top of page 2 of the class notes. Ownership, 0 to 20%. If that's all you own of a company, if we owned 100 shares of Coca-Cola, we own less than 1% of Coca-Cola stock. So if we show up at a shareholders meeting, you think they're gonna roll out the red carpet for us and act like we're Mr. Bigwig and we're Mr. Coke? No. They're barely gonna even know we're there. Sit down and shut up, please, in the back. We have little to no influence over the company because we're such a small gnat on the wall. Well, the appropriate accounting for that is the fair value method. Out by fair value method to the far right, would you please write ACC372. ACC372. That's this class. Well, then you go from, what if you own between 20% and 50% of another company? Now you're presumed to have significant influence. And the appropriate accounting for that is account for using the equity method. Okay, by that I want you to write ACC372/416. We spend a lot of time on the equity method in 416, but we introduce it in this course. And then if you own more than 50% interest in another company, you are presumed to have a controlling influence. And the appropriate accounting in that case would be consolidation. That is also accounting 416. So, now, how long has it been since you took accounting 212, Mr. McCall?
212? 18 years.
Wow, okay.
Not expecting that one.
No, I was not. Did you remember that we used to have trading securities held to maturity and available for sale categories related to stocks? No, okay. I was gonna be impressed, so now I'm suitably not impressed. We did used to have both categories trading and available for sale for stocks, too. But no more. Plus, you can't have held to maturity. Stock doesn't have a maturity date. Only bonds have maturity. Okay? So it used to be that we had the first two categories for stock investments as well. But a couple of years ago, the FASB said, no, all investments in marketable equity securities will be reported on the balance sheet at fair value, with unrealized gains and losses reported as part of net income. So it's very easy. Report on the balance sheet at fair value with unrealized holding gains and losses in net income. So that's very much like trading securities for bonds. Exactly the same. Questions?
All stock investments?
I'm sorry?
That's for all stock investments?
All stock, if it's marketable, for all marketable equity securities. Okay, look at me. Do you have this with you? This is a Chapter 17 additional handout. How many do not have it? Ooh. Okay, can you go in there and print like 20 of them?
All right.
Or 25 of them or something? You have it or no? I print about 24 of them. Okay. We're going to talk about it while he's gone, but there is an illustration in your chapter, but they use weird account titles and I don't like it. So a few semesters ago, a student in my class sat down and did this in Excel and gave it to me, and I fixed it for the new standard, so I tweaked it. But here's the deal. Here is the fair value method illustrated, and here is the equity method illustrated for 4 or 5 different kinds of entries. The first one says, on January 2 of 14, Maxi Company acquired 48,000 shares, which is 20% of Mini Company, at a cost of $10 per share. Under the fair value method, we would debit stock investments. The new account title that we talked about, $480,000 in credit cash. Under the equity method, because you have significant influence over this company, we don't let you use a generic account title. You're going to use investment in Mini Company as your asset account. Investment in Mini Company, $480,000 in credit cash. Okay, the next entry. For the year 2014, Mini reported net income of $200,000, so Maxi's share is 20% or $40,000. Under the fair value method, we don't do anything for that. Under the equity method, you record your share. So you debit the investment in Mini Company for your 40,000 share and credit equity in earnings of an affiliate. That's an income statement account. I'm gonna ask that you write that down when he brings you in the copies. That is an income statement account. So if you have that with you, by equity and earnings of affiliate, write income statement account. Okay, then when Minnie pays a dividend to Maxie, under the fair value method, it's debit cash and credit dividend revenue. Under the equity method, no, we don't let you record that as revenue. We record that as a reduction in your cost basis. You debit cash and credit the investment account. You reduce the asset carrying account. Then, at the end of 15, Minnie reports a net loss of 50,000, and your share is 20% of 50,000 or 10,000. Under the fair value method, the left side, we don't do anything. But under the right side, we do something. We debit equity in loss of affiliate and credit the investment account. Just the opposite of what we did when we had share of income. And then at the end of the year, we do an adjustment to fair value under the fair value method, but you don't do that under the equity method. Are you with me? So, you're gonna need to spend some time and make sure you're comfortable with the similarities and the differences between accounting for these investments on the fair value method and the equity method. Now, the 0 to 20% and 20 to 50% and greater than 50% that we talked about on page 2 of the class notes are simply guidelines. Did you notice the heading said presumed influence? Like, for example, could there be a scenario that you own 40% of the company, but you really don't have significant influence?
Yes,
How?
because like one person owns the rest of it.
Yeah, I own the other 60%. So does it matter how you vote? You are a flea on a dog. You're just riding.
Yeah.
What'd you say for right now for,
Equity in earnings of an affiliate is an income statement account. How many more on that? Need another one on this, or is that it? You got it? Okay, I'm sorry. So, on the equity side, a little bit down the page says equity in earnings of affiliate. That's an income statement account. And then a little further down it says equity in loss of an affiliate. That is also an income statement account, but that time it's an expense instead of an income. Okay, I got another question. Suppose you own 80% of a company. Could it be that you do not have, in fact, a controlling influence? Not possible?
20%?
Aren't there sometimes whenever it's like a family business, if like the family has like, I know it can be publicly traded, but they have like pretty much all of it.
Yeah, but could you own 80%? Could you be the family that owns 80% but not be in control?
Oh, but it's
Yeah.
separated for different family members?
Did you have a preferred stock?
No. It could be that the company is in bankruptcy and the bankruptcy judge is in charge. I mean, look, you could also, it could be operating in a foreign country, and there are severe restrictions on what you're allowed to do based on governmental law. So just because you own more than 50% does not necessarily mean that you are in charge. Any more so than owning 40% means you have significant influence. If I own 60%, then you really don't have any influence at all. We don't even need you to show up to vote. I'm in charge, right? So you can't have significant influence if you're not even needed. I mean, if you vote with me, then you win. If you vote against me, you lose every time. So my point is, you have to be careful. The percentages are guidelines. Listen to me now. Did we talk in here about Enron? The 3% thing? They would only have 3% of the stock in the company, but they would appoint the members of the board of directors. They would appoint the CFO as the president of the company, and they would agree to put more equity in the company if the company needed it. ARB 51, Accounting Research Bulletin 51 says, if in fact you have control over the entity, you're supposed to consolidate. They structured it in such a way that it looked like they did not have control, when in fact they did have control. You didn't have to do FIN 46 or FIN 46R because you had control. According to current accounting guidance at the time, you should have consolidated those entities. But they didn't want to because they were money losing and they had a lot of debt on them. They wanted to keep them off the parent's balance sheet. Okay. Turn to page 3 of your class notes. Look at this first paragraph. As we covered in earlier chapters, companies have the option to report most financial instruments at fair value, with all gains and losses related to changes in fair value reported as part of net income, even if the specific investment is an available for sale security. This option is applied on an instrument by instrument basis. The fair value option is generally available only at a time when the company first purchases the financial asset or incurs a financial liability. If a company chooses to use the fair value option, it must measure the instrument at fair value until the company no longer has an ownership interest. Next paragraph. Note that the fair value adjustment account is not used under the fair value option. Instead, the fair value adjustment is made directly to the investment account. Okay, now, sometimes students get this confused. There's the fair value method of accounting for stock investments. And there's the fair value option that is available to be selected for any financial asset or liability. And if a company elects the fair value option, it will account for that financial asset or liability at fair value with unrealized gains and losses reported as part of net income, and we will not use a fair value adjustment account to go with it. We make the adjustment directly to the asset account. So you've got to understand the difference between the fair value method and the fair value option that is being talked about on page 3. Okay? All right, now, skip over impairment of value, and I want to talk about reclassifications. All right, look at this. Let's say that you own stock in Ford Company. You purchased it for $100,000. Okay? Now this is stock. And we learned over there, since Ford is a traded security, we're gonna report these on the balance sheet at fair value, right? With unrealized gains and losses, since being part of net income. Okay? So, a few months later, the value has increased to $110,000. So, we adjusted the asset from 100 to 110. We reported an unrealized holding gain on our income statement for $10,000. That became part of net income. Net income got closed into retained earnings, and retained earnings is part of stockholders' equity. You with me? Okay, now, the next week, this value shoots up to $115,000, and we decide to sell it. Now think. You bought it at 100, you wrote it up to 110, and now you actually sell it at 115. So that's a $15,000 increase from the time you bought it to when you sold it, right? Okay. Last year we included $10,000 increase from when we bought it at 100 and it went up to 110. Now we're going to sell this stock, and here's the journal entry. What's the stock investment going to be adjusted for? 110, right? Isn't that what it was on the last year? It was 110. And then we're going to report gain on sale for $5,000.
Why was it 110 again? Why was it 110 again for the stock investment?
Because you had adjusted it from the original, I'm sorry. That's not right. Even though you have adjusted it, you go back to the original cost basis for your journal entry. All right, now this is, be very careful, listen to me. So now, if that gain on sale is reported on the income statement at $15,000, and last year you increased net income by $10,000, you're increasing net income by $25,000, aren't you? When really, it only went from 100 to 115. So, we have to do what is called a reclassification adjustment for the $10,000 that happened last year, so that we don't double count it, right? If you will look, let's look in your book toward the end of the chapter. On page 921. Down in illustration 17-30. Amount reclassified from accumulated other comprehensive income, $25,000. Or, as you see on the previous page, let's see, where do they show it? Well, it doesn't look like they give me a good example for trading securities. They're doing this for available for sale securities. So we'll do one, and we actually will demonstrate it in a problem, because they don't have a good illustration here. All right? Okay. So, folks, that's a lot of new terms, a lot of new accounts, a lot of new information. So, and remember, We will wrap up this chapter on Tuesday. And the next chapter, chapter 12, is as close as we come to a gift chapter in this course. So we may very well finish chapter 12 next Thursday, which will mean that we will be ready for an exam, second exam, because it covers 16, 17, and 12. So, do we get any time off for July 4th? Because July 4th falls on a Wednesday and my classes are Tuesday and Thursday. So, we could have our exam on July 3rd or Thursday, July 5th. Huh? The 4th? Before July?
Yes.
What?
Well, we're not gonna finish the chapter until the 28th of June.
What are y'all doing on July 4th?
Nothing. You're in my class. You're not supposed to do anything but accounting.
The 4th?
If you want to pass the class.
I really have passed, not gonna work.
That's what he's saying.
She said, we're doing on July 4th.
Exactly.
You be thinking about it, because I don't care. But we'll probably finish chapter 12 next Thursday. And we're ready for an exam either on the 3rd or the 5th. And we gotta have it.
The 3rd.
So what y'all talk, we'll vote next week. Okay. Please turn in your book to page 951. I'm looking at exercise 6. Look at exercise 6. The following information is available for Barclay Company at December 31 of 17 regarding its investments. We have 3,000 shares of Myers Corporation common stock that cost us $40,000, but has a fair value of $48,000. And we have 1,000 shares of Coal Incorporated preferred stock that cost us $25,000, but has a fair value of $22,000. A says, prepare the adjusting entry, if any, for 2017, assuming no balance in the fair value adjustment account at January 1 of 17. Neither of Barclay's investments result in significant influence. So that means we should use the fair value method, right? All right, so now here, this is the chapter I was telling you earlier. If you don't know how to use T accounts, you're gonna be in trouble in this chapter. So here's our new stock investments account. And on the left side, which is the debit side, we record cost. Now look, we treat multiple investments that are in the same category as one investment. We're not going to do two adjusting entries for this. We're going to do one. The total cost is $65,000. Okay? Now there's a brand new account called fair value adjustment. Fair value adjustment. We need the combination of these two, since they have to be reported at fair value. And what is our fair value? 70?
Don't separate them out either, right?
No. We treat them as one. We call it a portfolio. We treat it as if it's one investment. Okay, so now you look up here. The fair value adjustment account, listen to me, this is not a contra account. Because a contra means you subtract from. This one can be subtract from or it can be add to. If it's a subtract from account, that's a contra. If it's an add to, it's called an adjunct. Like, if you were to come out here at night and take principles of accounting, you might have somebody that you say, well, I've never seen that person before. They're not here during the day. It's because they're an adjunct faculty member. They only teach a class at night. They want to teach, want to do something, and they're called an adjunct faculty member. So adjunct means you add to your regular faculty for teaching this class, that class, or the other. So don't think of this, oh, this a contra. No. That account has got to go with another account. It can't be by itself. Can you have discount on bonds payable without having bonds payable? No. Can you have the allowance for doubtful accounts without having accounts receivable? No. You can't have fair value adjustment account without having the account that it's adjusting to fair value right along with it. So you tell me, do I need to have an amount on the debit side of the fair value adjustment account or on the credit side? What'd you say, Ms. Jones?
Debit,
Debit. How much?
5,000.
5,000. Therefore, what is the journal entry? Debit? No. What account did I just debit? Fair value adjustment, 5,000. And what am I going to credit? What do they tell me these are? These are, oh no, it doesn't matter. Unrealized holding gain.
Do we have to do dash income too?
Huh?
Do we do dash income or is that not?
No, because for stocks, they all go to income. So you don't, if it's bonds, you are gonna have to say where it goes. So if you wanna get in the habit of saying dash income, fine. Now, gains and income revenue are both credits. So if you need a credit, that's gonna be gain. If you need a debit, that's gonna be unrealized holding loss, right? So that one's also 5,000. How are we doing? Okay, now, you don't have to write this down, but if you choose to after we go through the illustration, I will give you the time to do it. But look at how brilliant this illustration is. Let's say that on the next balance sheet date, what kind of entry, by the way, is that? That's an adjusting entry. When do we do adjusting entries?
Or whenever the financial statement.
Immediately before we prepare financial statements. Why do we do adjusting entries? Some account balances are no longer accurate due mainly to the passage of time. How do we do most adjusting entries?
With the balance sheet account and the income statement account.
Fair value adjustment, what kind of account is that?
Balance sheet.
Balance sheet, unrealized holding gain, income statement. So now on the next balance sheet date, the fair value is 78,000. And let's just say it's a year from now. So what will this adjusting entry look like, Mr. Evers? Debit?
Fair value adjustment.
How much?
8,000.
8,000? Credit?
Unrealized holding gain. Also 8,000.
Okay, I hope you're not writing that down, because I asked you not to. Because look, 65,000 plus what will give me to 78,000? Hmm? 13. So the question is, how much do I need to make the adjustment for? 8,000. You with me? You've got to be able to manipulate the fair value adjustment account for as many years as you need to. So that is for 8,000. Okay, now let's change it up. And let's say on the next year end, the fair value has dropped to 55,000. Okay, so here's what I say. The way you should do it is first say, what do I want to be under the line? What do you want to be under the line now?
A credit for 10,000.
A credit for 10,000, because 65,000 minus 10,000 is what will give us 55,000, right? So that's what we want. How do we get there? How much is the adjustment going to be for? 23,000. So debit, unrealized holding loss, 23,000. Credit, fair value adjustment, 23,000. Questions? Now this is the chapter where people, sometimes students who say, well, my teacher really didn't do T accounts, so I'm not used to doing T accounts. Well, you need to go back and hit them, because they should have gotten you into T accounts, because now what you gotta do? It's gonna be really hard. Try to pick up an affinity for T accounts this far into it. Okay, that's part A. Part B says, so if you want to write that part down, you can. But my point is, you could just keep right on going, bringing this down for as many periods as you wanted to. Think about it, if you're doing them every quarter. You'd have 4 adjusting entries to do each quarter. For the year, right? March 31, June 30, September 30, and December 31. So putting these together, I think, should help you to see how the information flows.
Brian, the unrealized holding loss for the next year, was it 23,000?
Yes, 23,000. Okay, here, what some people will say is they say, oh, that's 3,000. They're just looking at the difference between these two and say it needs to be 3. Well, if I credited this 3, will the answer be 10,000 on this side or 10,000 on this side? 10,000 on the debit side. When they're on opposite sides, I have to add them. When they're on the same side, I get the difference. Okay, so that's part A. Part B says, how would these amounts be reported on the financial statements? Well, on the balance sheet, stock investments, you would say at fair value, 70,000. In parentheses, you'd have a little at fair value explanation, $70,000. Your income statement under other revenues and expenses, you would have unrealized holding gain, 5,000. That's what they're asking. It's just, okay, now that you've adjusted to fair value, how's that going to affect the financial statements? Questions? Okay, that was exercise 6. Let's go to exercise 9. Looking at exercise 9, it says, at December 31 of 17, the available for sale debt portfolio of Steffi Groff is as follows. Okay, so these are not stock investments. These are debt investments. And we need to say available for sale. And the fair value adjustment also goes to available for sale. Okay? The cost of these security A, security B, security C is $53,000. Okay? Available for sale securities are reported on the balance sheet at fair value. Okay? So looking at the information, what is the fair value of these in total? $54,500. And they tell me that we had a previous fair value adjustment balance of a debit of $400. So they want us to prepare the adjusting entry at 12/31 of 17. To adjust these investments to fair value. Okay? So what are we going to do? I say you need to decide what number do you want to be below the line in the adjustment account. 1,500 on the debit or credit side? Debit side. So now it's easy to figure out what the adjustment needs to be for. Okay? So what's your journal entry going to be? Debit, fair value adjustment dash AFS, 1,100. Credit, unrealized holding gain, dash equity, equity. $1,100. Then show the balance sheet presentation of the investment related accounts at December 31 of 17. Well, again, we would show debt investments, parentheses, at fair value, parentheses closed, $54,500. similar to what we just did for stock investments in the last problem. Okay, then look at letter C. Prepare the journal entry for the 2018 sale of security A. Okay? Notice the sentence just above the instructions. On January 20th of 18, Steffi Groff Inc. sold security A for $15,100. These sale proceeds are net of brokerage fees. Okay, so date your entry for letter C, 1/20 of 18. And what you gonna do? Debit. Cash. How much cash did you get? 15,100. Okay, skip a line. Credit, debt, investments, dash, AFS. For how much?
17,500.
17,500. That is correct. Does that journal entry balance? So what do you need?
Loss on sale.
Loss on sale. What's that, 2,400?
Yes.
And that's dash equity, correct? Dash equity, is that correct? Do we put that with that? Does it matter?
With loss on sale.
No. Loss on sale, that's a realized, and all realized losses go to the income statement. So you got to be very careful whether we're talking about unrealized gains and losses, because all realized gains and losses always go through income. Questions? Yes, sir.
What would be, like, what's the sentence for like the last, problem for B?
Debt investments, parentheses, at fair value, parentheses, close, 54,500. Okay, turn over and let's look at exercise 12. Exercise 17-12. The following are two independent situations, and they name them situation number 1 and situation number 2. The instructions say prepare all necessary journal entries in 2017 for both situations. So let's go to situation number 1, and then we'll do number 2 on the other side. So situation number 1 reads as follows. Conchita Cosmetics acquired 10% of the 200,000 shares of common stock of Martinez Fashion at a total cost of $13 per share on March 18 of 17. Okay, since we bought 10%, what are you automatically thinking? Fair value method, right? All right, let's keep reading. Martinez declared and paid $75,000 of cash dividends to all stockholders, and on December 31st, Martinez reported $122,000 of net income for the year And at December 31st, the market price of the stock was now $15 per share. Okay, they don't tell us specifically whether or not we were able to exercise significant influence. But since they told us we own 10%, we're going to default to no, we're not able to exercise significant influence. So we're going to do this on the fair value method. So what account do we use when we purchase this right, this investment? Debit? Stock investments. Debit stock investments. How many shares did we buy? 20,000 times 13. Is that 260,000 or 26,000?
It's 200,000 shares.
No, you bought 10% of 200,000. The 200,000 is the total. 260. And credit cash. Now you gotta always be careful to read, because the next time they may say you bought 400,000 shares. Well, now you're gonna use the 400,000, right? So you gotta always be careful to read what's written there. Okay, on June 30, Martinez declared and paid 75,000 of cash dividends to everybody. That's the total. Okay, what should we do under the fair value method? Debit, cash, and credit dividend revenue. But how much? 7,500. Take the 75,000 and multiply by 10%, and that'd be 7,500. Questions?
How did you get the 260 again?
The what?
The 260?
20,000 shares times $13 a share. Okay, the next sentence says, on December 31st, Martinez reported net income of $122,000 for the year. Under the fair value method, what do we do with that? Nothing. Then it says at December 31, the market price of Martinez Fashion is now $15 per share. Under the fair value method, do we do anything with that? Yes. Well, first of all, we paid 13 and they've gone to 15. So that would be an adjustment to fair value adjustment for $2 times 20,000 is 40,000. And credit, unrealized holding gain, 40,000.
For the part where it said, we recorded net income of 122,000, if that part was like down in the exam, do we have to write no entry or?
No, you just don't record anything. Because, I mean, it says prepare all necessary journal entries. So there's nothing for you to do under the fair value method, so you don't do anything. Are you with me? Okay, go to situation number 2. Monica Inc. obtained significant influence over Celis Corporation by buying 30% of Celis's 30,000 shares outstanding of common stock at a total cost of $9 per share on January 1 of 17. Okay, we obtained significant influence. So that's telling you, you have to use the equity method. So when you use the equity method, you don't call it stock investments. What do you call it? Investment in Celis Corporation in this case, right? How many shares did we buy, Ms. Jernigan?
30% of 30,000, so.
9,000. Okay, so 9,000, and what did we pay for them?
$9.
$9 a share, so that's 81,000. And credit cash. Are you with me? Look at the next sentence. On June 15, Celis declared and paid cash dividends of $36,000 to all stockholders. Okay, when we receive a dividend under the equity method, what do? Debit, cash, and credit the investment account. Okay, how much of the 36,000 in total dividends we got 30%? 3 and 6, 18, 8, carry 1, 3 minus 3, 9, 10, 10, 8?
Yes.
10, 8. Next sentence. On December 31, Celis reported net income of $85,000 for the year. Under the equity method, do we do anything with this?
Yes.
Yes. What do?
Investment.
Record our share of the total net income, right? And since the entity had net income, that's going to be a debit to investment in Celis Corporation and a credit to equity in earnings of affiliate. 85,000 times 30%, 3 and 5, 15, 5 carried 1, 3 makes 24, 25, 5. And I got it before you did, didn't I? Ha! 25, 5. Now there's a flaw in this problem because I wish the next sentence was, at the end of the year the investment was valued at $92,000. The fair value of the investment was $92,000. Do we care? No. Well then why did they give us how much net income the other entity had in part 1, trying to get us to nibble on some unnecessary information, but then not give us the unnecessary information in situation number 2? They ought to have given us both and forced us to say no.
They felt bad.
No, I doubt that. Are you with me? Questions? Okay, so now I want you to think about this. You always start with recording the investment account at cost. Isn't that what we did right there on 1/1/17? Investment in Celis for the $81,000 we paid. Okay? Then, the investment account will be increased for our share of the sub's net income. It would be decreased by our share of the sub's net loss. It will be decreased by our share of cash dividends paid by the sub. And that is the extent of what you have to know about the equity method in 372. In 416, we will add a lot to this, a lot more complexity to this account. But for now, that's all you have to know. The good thing is I've gone through the Gleim book and picked out the questions you should ignore because they are 416 questions and not 372 questions. So I've excluded them already for you. Questions? But so you will revisit. I mean, the first 6 chapters of 416 are all about the equity method. So we get back into it in a lot of detail in 416. Here we're supposed to just introduce you to the idea. And then on the first day of 416, I put something like this and something like that Excel spreadsheet that he copied for you on the board to show you the difference between the fair value and equity method. And then we focus on the equity method in chapter 2, 3, 4, 5, and 6. So it's important that you get a grasp of the equity method now, and then you'll get it in heavy doses in 416. Okay, I'm gonna ask that you do exercise 15 and exercise 16. Exercise 15 and 16 are homework. And they will be due on Tuesday.
Just those 2 are due Tuesday.
For now.
Okay.
Okay, so let's see. Also, problem 4. So whatever those 2 exercises were, and problem 4 will be due on Tuesday. And I will grade them and get them back to you on Thursday so that you will have them back. But we have done enough of this that you should be able to do those. For example, exercise 15 is very similar to the first 2 exercises we just did. We're adjusting from cost to fair value. Exercise 16 is very much like exercise 12. Fair value and the equity method. So I'm going to do right now exercise 18. Look at exercise 18. Impairment of debt securities. Hager Corporation has municipal bonds classified as held to maturity securities at December 31 of 17. These bonds have a par value of $800,000, an amortized cost of $800,000, and a fair value of $720,000. The company believes that impairment accounting is now appropriate. Okay, listen to me. Impairment accounting means you think that this decline is in value, listen to me, is other than temporary. Other than temporary. You say, oh, that means it's permanent. No, it's other than temporary. All right, so look, here's where we are. We have an account called Debt Investments, HTM. These have a cost, an amortized cost, and a cost of $800,000. But you have decided that impairment accounting is appropriate now, and that the fair value is $720,000. Okay? Are you with me? Get out your class notes and please turn to the last page of the class notes where it talks about impairment. It might be the next to last page. It is the next to last. Page 3. Impairment of value. A company should evaluate every investment at each reporting date to determine if it has suffered an impairment, a loss in value that is other than temporary. If a decline in value is judged to be other than temporary, a company writes down the cost basis of the individual security to its new fair value, which becomes its new cost basis. So they're telling us we need to write that thing down from $800,000 to $720,000. Read the next paragraph. For debt securities, a company uses the impairment test to determine whether it is probable that the investor will be unable to collect all amounts due according to the contractual terms. That's us. Okay, so, and does it tell me the date? Is it December 31 of 17? Okay? So help me. What would the journal entry to record this other than temporary decline in value look like? Debit?
Loss on impairment.
Now, I want you to think about that, Mr. Evers. If I debit fair value adjustment, am I making it higher? I'm adding to the $800,000. Plus, under held to maturity, I don't even have a fair value adjustment account. What's it going to be? What's the debit going to be? Well, let's forget the debit. What's the credit going to be?
Debt investment.
Yeah, we're going to credit this account. So credit debt investments dash HTM 80,000, right? So when I credit that, that gets me down to 720, which is the fair value, and it is also the new cost basis. But do you know what the debit is yet? Loss on impairment, 80,000. Loss on impairment. Where would that be reported in the financial statements?
Other income losses.
On the income statement. That will be reported on the income statement under other revenues and expenses. Are you with me? Okay, that's part A. Part B says, what is the new cost basis of the municipal bond? Well, there's the answer right there, 720. Next sentence says, given that the maturity value of the bonds is $800,000, should Hager Corporation amortize the difference between the carrying amount and the maturity value of the bonds?
Is it against C or B?
I'm still on B.
No,
Read what it says. Why?
Because you don't know if you're holding it to maturity.
Wait a minute.
You might not,
What have you got it classified as?
other than temporary.
No.
Oh.
Held to maturity. No.
Oh, yeah.
How do you account for held to maturity securities though? Go back to page 1 of your class notes. Held to maturity securities are reported on the balance sheet at amortized cost, not fair value. Folks, you just said, I think this is an other than temporary decline in value. I'm not going to get 800,000. I think I'm only going to get 720. So now you're going to turn around and start increasing it back from 720 to 800? No. Because you said, if this is other than temporary, I really don't think I'm going to get 800,000. All right, now go to C. At December 31 of 18, the fair value of these securities is now $760,000. Prepare the entry to record this information.
And that's just the adjustment, right?
Do what?
That's just the normal adjustment, right?
Yeah, so what are you going to do? Mr. Jackson, what category of investments are these? Held to maturity, which are reported at what? So why are you going to adjust them to fair value?
Oh, no.
You're not going to adjust them to fair value because these are held to maturity securities. Ms. Johnson, if you think doing the homework in the lecture is stressful, wait till you get the second exam. If you don't know how these are all accounted for on the balance sheet and where the unrealized gains and losses and all that crap go, it's going to be a long 75-minute exam. So, I'm thinking a quiz on next Tuesday might be appropriate. If you remember when we went over your syllabus, I told you that I have the option to give quizzes if I decide you are not adequately preparing for class. So I think what I would do if I were you is I would study the 3 pages of the class notes that we went over. And I mean study them, know them cold. In case I decide I want to give an exam. I'm going to pick up with exercise 19 and then do a couple of problems, and then we're through in 17, and I'll go on into 12. So, bring your chapter 12 class notes to class with you on Tuesday. All right, thank you for coming and good day.